Bless Squad, what's going on with y'all, man? It's your boy, Blessed Applesauce, to bless y'all with another video here on Blessed to Invest. And today, we are here to talk about the structure, how to properly structure a long-term portfolio. Because in the last video, I was talking about, okay, one thing you can do to invest is to build a long-term portfolio that's like with your own money, you're doing it by yourself. But in this video, we're going to talk about the breakdown of how actually to break this down. So before we get into it, make sure you spam the like on this video, spam the like button. That's the first step to getting your portfolio right. That's like the good luck charm to great success in your portfolio. Hitting that like button, also sub down below for more content like this. But getting into it, before we even, I always tell people, the easiest thing you can do is buy the SPY. Like, buy the SPY, everything's gonna be all right. Buy the SPY, you'll never die. That's my motto. I don't know if somebody took that motto or whatever, but the S&P 500 is the easiest way to make money in the market. What it does, you purchase it, and then it gives you the top 500 companies in the market, and you're gonna own a little piece of those companies in your portfolio. So you're gonna own a little bit of Apple, a little bit of Microsoft, a little bit of I think Tesla's in there now, a little bit of Amazon. You're just gonna own a small piece of those. And whenever something gets kicked out of the top 500, you're gonna lose that and you're gonna regain whatever the next top 500 company is. So it automatically gives you the best companies in the market, which is super easy. So if somebody wanted to structure their own portfolio, the simplest thing you can do is literally just buy that and call it a day. 100% just buy that. You're gonna get a cool average 7% return. I know this year, 2021, well, last year, 2021, we got like 37% return, something crazy like that, like 30%. So for you just using that strategy alone, just sitting in the SPY, calling it a day, you're just gonna make money. Like, it's the simplest way. Everybody tries to day trade. Everybody wants to be a swing trader. Everybody wants to be the next hedge fund guy, blah, blah, blah. And I know on this channel, I do day trade. I explain a lot of day trading techniques and a lot of swing trading, stuff like that. But really, somebody that doesn't really want to get into that and have the extra risk of learning how to do it and all that stuff, the simplest thing you can do is just buy the SPY. Call it a day, buy the SPY. You don't got to worry about going through the period of just losing money for the first 2-3 years of trying to learn how to day trade. Buy the SPY, call it a day. But that's the simplest one. But to get into a little bit more detail, if you want to maximize your returns a little bit more, I want to structure, this is how I structure my portfolio, and I structure it based on percentage. So let's say you have $100,000. Let's do 10 grand. 10 grand is a little bit more reasonable. Let's do $10,000. Let's say you have $10,000. With that $10,000, what I recommend is doing 40% in the S&P 500. Buying a SPY, 40% S&P 500. And with that, I say that because, just like I said before, it is an easy return. You know you're going to get consistent money. It's a low risk, decently returned, especially over the long term, where you know that 40% is going to give you a good return on your money. So you putting in $4,000 in this case of the 10 grand, and you can just change it up based if you're doing $1,000, $100,000, $1 million, whatever. You putting 40% or 4 grand in there of that 10%, of that 10,000, you're going to get those returns consistently and repeatedly. And I can basically guarantee you that you're going to make money over the long term. We have a track record of about 250 years of this thing. It's pretty consistent on what it does. So I put 40% in the SPY, just guarantee easy money. The next thing that you want to do, I want to allocate 30% and or 3 grand in this case from the $10,000 scenario, putting $3,000 into blue chip quality stocks. These are not stocks that your somebody told you about at the barbershop. These are not those stocks. These are not hot stock tips. None of that. These are blue chip quality companies that have standed the test of time. They've been through the recession of 2008. They have a track record. They have a lot of cash on hand. They don't go into a lot of debt. Everybody knows about these companies. These are popular companies. And when I'm talking about companies like Apple, everybody knows Apple. Everybody knows Apple is not going anywhere. 5 years from now, we're pretty sure Apple is going to be around in some way, shape, or form. It's huge. It makes a lot of money, $1 trillion valuation. It's huge. That's a blue chip company. Quality, low debt. The next one, you want to maybe look at like an Amazon. Just throwing some names out there for blue chip. You can also Google blue chip. Come up with a list of names that you can get into. The Amazons, Microsoft, Walmart. What else? Just quality company, Coca-Cola, quality companies that everybody knows that have stood the test of time, that are going to continue to stand the test of time. I want to put 30% in that. The reason why I want to do that is because I want to add to, this is going to be riskier, a little bit riskier, but these are blue chip companies, and I want to maximize my returns a little bit more, where the SPY is giving me about 7% average. These can give a little bit more with a little bit more downside risk, but a little bit more upside. Whereas Apple this year has done like 30%. Amazon's going to give you more than 7%. So being in these companies, one, you're going to get dividends. That's another thing. You need to make sure you get dividends in these companies. I would not recommend buying any blue chip company that does not pay some type of drip, some type of dividend. If you're not getting a dividend, I would not put it in my portfolio. These are big companies. They should have enough cash to pay something. Apple is huge. It pays a dividend. It's making trillions. It's making a boatload of money. It should be able to pay a dividend. And the reason why I say pay a dividend, because let's say this company drops down a little bit. Let's say it has a lean year where it's not doing as well. In those lean years, if you're holding this for 10, 20 years, in those lean years, when it's not performing, you're not getting your 30% returns, all these crazy returns. If it continues to pay a dividend, it kind of helps out your returns a little bit. So let's say you're flat. Let's say this year Apple does absolutely nothing. You'll get your little dividend, which can help your returns a little bit, where you can reinvest in Apple. Maybe you reinvest in the SPY a little bit. It helps out a little bit. So make sure those companies, those blue chip companies, are paying a dividend. And you want three grand or 30% in those type of companies. Next thing we are going to look at, I want to put 15% in a hedge. The reason why I say put 15% in a hedge, because you don't know what's going to happen. We could have a depression next year. We could have, I don't know. We just had COVID. Like, we don't know what's going to happen in the future. So I believe 15% is a good enough cushion. In this case, it will be $1,500 from the $10,000 example. $1,500 where you have a cushion, where you have some money on the side, where it's in a low risk, low return type of investment, where you can pull this money later on if you need it, or if all your investment goes it goes into depression, you still have that $1,500. Places you can invest this, you can put it in gold stocks, you can put it in like a gold ETF fund, you can buy actual physical gold, you can put it in a savings vehicle, like a high return savings. The word is slipping my mind at the moment. The high there we go, high yield savings. You can put it in bonds, something that is low risk. It's going to hold your money, but it's better than a savings account. It's going to hold your money a little bit. You're going to get a slow return. Maybe you're going to keep up with inflation a little bit. But if your entire portfolio goes down, this is still going to be here. That's what I want you to put into a hedge. That is very critical, very important, so you can sleep at night. You have your strong SPY that has showed a consistent track record for over 250 years. You have your blue chip companies, and 30% that have shown a consistent track record for maybe like 10 years, maybe 5, 10, 20 years, that are not going anywhere. And then you have your hedge that, if the world has another COVID, you're good. You're in a good situation. So that's the main bulk of your portfolio. Right now, we're looking at 85% of your portfolio. So literally 85% of your portfolio is in strong, solid stuff. It's not going anywhere. You can sleep at night. You're comfortable. And for me, I'm more conservative with my investments, because you don't want to play the game where you are hitting home runs, because if you get struck out, you literally have to start all over again. If you put $10,000 in and you strike out, you have to make $10,000 back again. And that takes a lot of work, a lot of time, and that's a lot of wasted returns over a long period of time. I was reading a book where they were talking about just simple returns. The biggest billionaires, these hedge fund guys, they get consistent, easy returns every year. And they avoid the strikeout. They avoid the big losses. That's what you want to do in your portfolio. Avoid the big losses, because when you avoid them, it's easy to continue to grow. When everybody else is taking a 50% hit and you just slowly getting your 3%, 3%, 3%, 3%, or your 5, 10, or whatever, and you're avoiding that big loss, those people that took the big hit, it takes them another 5, 10 years to recover where they got from, while you're still compounding over and over. So that's where the bulk of this portfolio is going to be. 85% is going to be in consistent, strong stuff and safe stuff. With this 15, this is where we're going to get a little fun. So with 12%, I want to put it in growth funds. So in this scenario, you're looking at $1,200 from the 10 grand. I want to put it in growth stocks. These are stocks that are a little bit more risky. They're a little higher risk, a little bit higher return, but they're still strong, solid companies. We're not looking at penny stocks. We're not looking at garbage. We're not looking at like these small cap arena stocks. We're looking at strong stocks. So these stocks can be stuff like Tesla. Tesla's been around for a pretty decent amount of time. It has a track record. It has some growth. It has a solid CEO around it. It's making consistent money. You're seeing Teslas around, but it's still considered a growth stock based on the risk it can take. It can take a 30% hit, potentially. It can have a 100% return on the year. Crazy stuff like that. But you're putting yourself in a situation where 85% of your portfolio is safe. I want to use the word in quotation safe, because anything can happen, but generally you're in a pretty good safe position. You have a long track record of history to look at. So when you get into stocks like Tesla for your growth stocks, it's going to be a little bit risky, but if you take a hit, you're going to do okay, especially if you divide it out between growth stocks. So you're looking at $1,200, maybe you pick 4 or 5 different growth stocks. Maybe one goes bad and 3 of them do amazing on the year. You're going to make up for that loss and you're going to continue to grow. So that's what I like to do with that 12% there. Add it and put it into great growth stocks. That's going to be the best way to get like really good returns. With this one, I don't look at dividends as much. I really don't care about dividends, because with that $1,200, I'm trying to make it grow. I'm trying to make it go to maybe 30% return on the year, or 50%, or maybe a home run 100% return on the year, which can really make my year. So that's what I like to do. And you're probably wondering, what am I going to do with the last 3%? You're probably calculating, okay, we got to 85, we put 85, then we're at 97. Like what goes on with that last 3%? And this, I like to have this as a percentage where you're doing whatever with it. It's kind of fun money. It's kind of your gambling money, because I feel like in investing, it should be fun. I should say you should add your own character to your portfolio. And that gives you the 3%. Maybe you want to speculate on a new IPO that just came out, or maybe you want to speculate on this new penny stock or whatever. But you don't want to put the bulk of your portfolio on. You don't want to put half of it. You don't want to put 25%. You want to put 3%. So in this scenario, we're putting $300 into a couple of penny stocks that may be hot, that you think might do well. Maybe you throw it into a GameStop. Maybe you throw it into AMC. Maybe you throw it into, I know for me, I put mine into, what came out this year? I put it into Krispy Kreme this year. $300, my 3% into Krispy Kreme. It's not doing well. It's kind of getting a little shaky here and there. I put it into Krispy Kreme, and I put it into, it was another stock. I can't remember off the top, but I put it into Krispy Kreme, and it's not doing amazing right now, but sometimes you can get into those GameStops, those AMCs and stuff like that, where it's just going to really take off. So that's what I recommend for that last 3%. Put it into a little bit of speculative investments that really fit your personality, that you're looking at. You're like, oh, maybe this can do well. If I take a loss on it, it's not going to hurt my portfolio too bad, because the bulk of my portfolio is in strong stuff. 85% is in really strong stuff, and that 12% is also in really strong stuff, but the returns are going to be, the risk and return is going to be a little bit higher. So really 97% of your portfolio is going to be really strong, really solid, and really stand the test of time for the long term. That's what we're in there for. We're in there to make money over the long term. We're not looking at the 5-month plan. We're not looking at the 2-day plan, the 2-minute plan. In this scenario, we're not day traders. We're not swing traders. We're trying to be there for the long haul to make a lot of money. But let me know down in the comment section down below, is there anything you would change about my portfolio structure, how I'm structuring my portfolio, the best and most effective way to structure your portfolio for the long term? Let me know down in the comments down below, and what has led to your success. If you have any, let me know down in the comment section down below. Let me know some stock tips that you're looking at, some stocks that you love, you're in, etc., etc. We can chop it up in the comments and have a nice little community section. But that's gonna wrap it up. It's been your boy, Blessed Applesauce. Stay blessed, and I'll see y'all next time on Blessed to Invest.
Just to see tomorrow is a blessing. Stay prayed up is the message. Everything about a nigga blessed. Everything about a nigga blessed.